we going to go in a recession? Well, that's a good question. By definition, we will be in a recession if the second quarter GDP, which is ending next week, shows up as a negative. If we go in a recession, Larry, what's going to happen to mortgage rates and housing prices? Larry Gonzales over here at Align Mortgage. Before I begin with my mortgage market minute, my recap of what's going on in the housing market, if you could please like, subscribe, comment on my video when we're done. I tell you what, I would be greatly appreciative because it helps me grow my audience so that I can educate more people. I want to talk about really what's all over the news this week, and that is our Fed Chair, Jay Powell. He's at Capitol Hill this week, and he was talking to the Senate, and he was talking to Congress, the House of Representatives, about inflation and what they're doing. Obviously, they raised the Fed funds rate last week, 75 basis points. And before that, and if you listen to the president, they've been talking about it's not inevitable that we go in a recession. Well, you know what? His tone has changed this week. To Congress, he said, hey, a soft landing for our economy is going to be very challenging. Hasn't said that before. And he said that recession is certainly a possibility. It's going to hurt. It's probably going to hurt a little bit. All right. And in his defense, there's some things that he does not control with inflation. And I think if he does get inflation down, he's only going to go so much because of things that are out of his control, namely supply chain, Russia, Ukraine, energy, those things he doesn't control. He controls Fed fund rate and has somewhat control over unemployment. I want to talk about his challenge right now because it is a pretty big challenge. And I got a chart up here that shows other Fed chairs and the problems that we've had. I want to dispel this one myth. The Fed fund is not raising mortgage rates. I've seen and heard that said so many times. The Fed is not doing that. They're raising the Fed funds rate, which controls the short-term rates that banks use to borrow money from each other. It also affects your lines of credit, credit card debt, and auto loan debt. All right, so let's go back in history, back to the late 70s, early 80s when inflation was running rampant. You look on this chart here, inflation had jumped from 7% to 14%. Can you imagine having a mortgage today with an 18% interest rate? It's insane. However, back in the day, home prices they weren't $1 million, they were like $100,000. So it wasn't that painful. Right? It's all about having a bit of perspective there. But what the Fed did to bring inflation down is they raised the Fed funds rate from 11% to 20%. That really knocked inflation down. It went from 14 all the way down to 5%. Mortgage rates actually dropped. Once the Fed started raising the Fed funds rate, they went from 18 to 12%. What is the impact of this on things outside the housing market? Well, consequences really. The S&P 500 was down 30%. All right, so we went into a recession. All right, and then in the 80s, Alan Greenspan, all right, he was Fed chair, and inflation went from 1.75 to 3.5%, so kind of in the middle. And he used the Fed funds rate really to kind of jockey inflation up and down to keep it under control. Rates were at between 7, they went up to 8.5%. He raised the Fed funds rate from 4.75 to 6.5. All right, inflation dropped. All right, Fed funds rate goes up, inflation goes down. Interest rates also went down, 8.5% down to 5.5%. But there was a big consequence there. S&P 500 dropped 50%, and we went into a recession. Now, there were some other things going on there too. That was the dot-com era. The big factor was the Fed bringing down inflation and raising the Fed funds rate. And then we come to today. We have Jerome Powell. He's sleeping in the bed he made, but some of it, he didn't have any choice in that, right? So inflation, all right, at the beginning of last year, we were around 2%. Everyone was happy. Well, inflation shot up to 8.5%. All right, the Fed has admittedly said we should have been hiking the Fed funds rate a lot sooner. Hey, it is what it is. We are where we are. All right, rates have gone up from 2.5% really to 6.5% on conventional. All right, they've already raised the Fed funds rate to about 75 basis points, so just over 1%. Expectation is that we'll get up to maybe 3.5% by the end of the year with successive rate hikes as we move on. All right, inflation response, well, inflation should drop. We don't know that yet. It will, but we don't know how much. The goal is 2%, probably not attainable this year. Heck, if they can get down to 4%, I'd say that's a victory, but that's not guaranteed. Although, I gotta admit, some of the prices are starting to come down. Fuel prices have come down a little bit, but they're still way out of control. All right, so what is a mortgage rate response gonna be? Mortgage rate's gonna come down too. All right, and I think they rose really quickly as an overreaction, and so right now I think rates are in a channel between, like, say, at least for VA, between 4.75 and maybe 5.5, and they're going to stay in that channel. They're going to go swing pretty rapidly at times, but I think we're going to stay in that channel for the near term, maybe the next 3 months or so. Stocks, well, what's going on with the stock market? Stock market is about 20-25% drop in the S&P 500. All right, that's pretty significant. Okay, so that's a consequence. There's a really good chance that we're going to go into a recession. You may ask, well, what if we go into a recession, Larry? What's going to happen to mortgage rates and housing prices? Once inflation goes up, mortgage rates go up, and when inflation comes down, typically mortgage rates go down. But let's take a quick look at that. This chart here shows mortgage rates, and then the dark bars are when we have a recession. And if you will look, today going backwards, went in a slight recession after COVID. All right, interest rates dropped. Before that, 2008, 2009, the Great Recession. All right, interest rates, they were at 6% going in. They went down to 4.875. And as you see, all these gray areas, interest rates actually went down within the recession, and then out of the recession, they continued to go down. Just know that just because we have a recession doesn't mean interest rates are going to go up. It is more than likely that interest rates will go down. When are we going to go in a recession? Well, that's a good question. By definition, we will be in a recession if the second quarter GDP, which is ending next week, shows up as a negative. What about housing prices, Larry? Do housing prices go up in a recession? Shouldn't they go down? Actually, they don't. Typically, if you go using the same recession chart, we're showing basically housing prices. All right, this is the Case-Shiller Home Price Index, which we all know is the gold standard for home appreciation. Housing prices go up. They've gone up every time except the Great Recession, which was when the housing market caused a recession in the first place. Now, through most recessions, the housing prices don't have this steep, crazy incline. It's more of a steady, slow rolling incline. If you look at, from all far right of this chart, all right, the incline coming out of COVID has been almost straight up. All right, it's not going to stay like that. Matter of fact, I was almost flatline, probably, maybe with a little tilt up. But as we go into recession, and mortgage rates go down, homes become more affordable again. All right, so that's kind of the answer to that question. Recession does not mean home prices go down and interest rates go up. Quite the opposite, actually. So let's go back to where we're at. What's going on this week? All right, kind of talk to you about kind of the rates, recessions. Mortgage applications last week, they went up actually 8%, right? So in the last week. So people are still buying homes. People are still applying for homes. There's still value out there. You just got to remember to stay in your budget. All right, the existing home sale report, all right, came out for the month of May. Existing home sales decreased 3.4% month over month. All right, not great, not terrible, but year over year, they're actually down 8.6%. Now that's pretty good, actually. I think that's pretty good, considering interest rates have gone up 2.8% from last year to this year. So despite such a huge spike in interest rates, existing home sales have only decreased by 8.6%, which goes to show that there is such a strong demand for housing and a very small supply. All right, it's really not enough to meet that demand. All right, rates, I already said before, I think rates were in a channel right now. All right, I think they rose way too quickly. I think as we get reports, follow-on reports on inflation, the consumer price index, which I think is a couple weeks. I still think inflation's going up, but I don't think it's going to go up quite as much. You know, who knows? We'll see what happens when it happens. I think we're going to stay in this channel, 4.75 to 5.5%. All right, we may pop out a little bit, but I think that's probably a good safe range for right now. Inventory is up across the nation 12.6% month over month. Although we still have less inventory on the market than we did last year. We're about 4.5% less inventory this year than last year at this time. And the months of supply is still heavily slanted towards a seller's market at 2.6 months of supply. Actually, we kind of need, I want to say between 4 and 6% is a more balanced market. 6 to 9 becomes a buyer's market. So still a seller's market, but sellers, all right, they're having a hard time. And I'm seeing people drop prices, all right, on their homes. Man, I think that's wrong, all right, unless you're way overpriced. How about sellers, realtors, talk to your sellers, all right? Instead of dropping your price, why don't you hook a brother up or a buyer up, give him a credit, a $10,000 credit. All right, you got a home for sale for $1.2 million. It's been sitting on the market for, I don't know, a month. Hey, you can keep it at 1.2, give them $20,000 in credit. All right, that will help either pay their closing costs, bring their rate down to something manageable, and boom, you're paying giving up $20,000 to save $80,000, rather than dropping your price $100,000 and then losing $100,000 altogether. Dude, that's the way we used to do it in the normal market. That's about all I got for you this week. Again, like, comment, subscribe. Hope you have a great weekend. Stay cool, and that's about all I got. Talk to you later.